South Africa, IFRS 7, Financial Instruments Disclosures, the complete, in-depth, audit-ready masterclass. Hello and welcome to CandiMentor. Today, we unpack South Africa, IFRS 7, Financial Instruments Disclosures, explained through the lens of JSE-listed entities, the Companies Act, and the expectations of South African auditors, regulators, and analysts. If you work in treasury, audit, investor relations, or corporate reporting, this session is for you. Why IFRS 7 matters in South Africa. Short anchor. IFRS 7 requires entities to disclose the significance of financial instruments, plus the nature and extent of risks they create and how those risks are managed. For JSE-listed companies, clear IFRS 7 reporting is essential because stakeholders focus intensely on liquidity, credit concentration, and currency exposure, especially Rand versus USD, Euro, or GBP. Two pillars of IFRS 7, the structural anchor. 1. Significance, carrying amounts, classes, fair value hierarchy, hedge relationships, P&L impact. 2. Nature and extent of risks, credit risk, liquidity risk, market risk, currency, interest rate, other price risk, and how these are managed. Start answers and interviews with that two-pillar structure. End. Standards ecosystem, alignment matters. IFRS 7 doesn't stand alone. It must align with IFRS 9, classification and ECL, IFRS 13, fair value hierarchy and valuation techniques, and IAS 32, presentation offsetting. Disclosures inconsistent across these standards are a red flag for auditors and regulators. Credit risk deep dive South Africa focus. South Africa's economy and market structure make credit disclosure the priority. What to disclose clearly: carrying amounts by asset class, trade receivables, loans, cash, derivatives, debt instruments, maximum exposure to credit risk, often equal to carrying amount unless mitigated, collateral and credit enhancements, type and fair value, concentration of credit risk, top customers, sector, geographic concentration, ECL information required by IFRS 9, staging 1, 2, 3, inputs, forward-looking scenarios and overlays, aging analysis for receivables past due but not impaired, 30, 60, 90, 120 plus days, with management's rationale for no impairment. Practical interview lines show the ECL staging and key macro assumptions. In SA, that often means GDP, commodity prices, and Rand forecasts. Example journal, ECL, full debit, loss allowance, credit, trade receivables, or loss allowance contra. This. Liquidity risk, the real test for many JSE issuers. IFRS 7 requires undiscounted contractual cash flows by time band, not carrying amounts. Disclose maturity buckets less than 1 year, 1 to 2, 2 to 5, total undiscounted outflows for borrowings, leases, trade payables, derivatives, and guarantees, covenant headroom, waivers, and breach risk, funding sources and dependency on major banks or short-term facilities. Common pitfall: presenting maturity tables at carrying amounts rather than undiscounted cash flows. Auditors flag that. Market risk, sensitivity, and clarity. Quantify market risk with sensitivity analyses. Currency risk. Disclose gross and net open positions, hedges, and sensitivity, e.g. 10% Rand movement, impact on profit/equity. Interest rate risk. Show exposure by floating versus fixed, and sensitivity, e.g. 1% change. Other price risk. Commodity, equity, price sensitivity, relevant to mining, oil, and agriculture. Example sensitivity phrasing. A 10% weakening of the Rand versus USD increases pre-tax profit by 4 million Rand and equity by 6 million Rand net of hedges. Hedge accounting disclosures. When hedge accounting is applied, disclose. Hedge type, CF, FV, net investment. Risk management objective and strategy. Carrying amounts of hedging instruments. Movements in OCI, deferred amounts. Amounts reclassified to P&L. And ineffective portions. Effectiveness testing approach and any sources of ineffectiveness. Auditors expect clear linkage between Treasury documentation and disclosures. Very clear and comprehensive. For financial instruments measured at fair value, disclose Level 1, Level 2, Level 3 classification and valuation techniques for Level 3. Significant unobservable inputs for Level 3 valuations. If Level 3 instruments exist, users must see a roll forward and sensitivity to key inputs. Journal example, FVTPL, full debit fair value loss credit, financial asset. Offsetting and presentation. IAS 32 ties. If offsetting is applied, provide gross amounts, amounts offset, net amounts presented, details on master netting and collateral. Banks and trading houses must show these clearly. End. Disclosures for receivables past due but not impaired. Provide aging buckets and explain why credit risk hasn't been recognized yet. Show for each bucket the best estimate of collection probability or supporting evidence. For example, strong collateral or active recovery arrangements. Reconciliations and roll forwards. Transparency. Include movements for loss allowance, opening, transfers, changes to ECL, write-offs, closing. Level 3 fair values, opening, gains losses, purchases/sales, transfers/closing. Derivatives, opening, new hedges, settlements, fair value changes. These roll forwards show how the risk profile evolved. End. Narrative risk management, governance and processes. Readers expect a short but clear narrative. Who sets Treasury policy and approves hedges? Audit, Risk Committee, CFO role. Risk limits and concentration thresholds. Stress testing processes and scenario design. Escalation and governance for covenant breaches and liquidity crises. Links to board-level risk oversight. That's South Africa-specific examples to use in interviews. Credit concentration. 30% of receivables tied to 3 mining customers. Liquidity maturity. Show funding cliff and renewal assumptions for bank facilities. Currency sensitivity. Quantify impact of rand-dollar moves for export revenues. ECL overlays. Explain commodity price or load-shedding overlays used for mining retail portfolios. Audit procedures you should expect. Big Four style. Audits focus on completeness and reasonableness. GL scanning for financial instrument population completeness. Confirmations for bank balances, loans, derivatives and guarantees. Recalculation of maturity tables, undiscounted flows. Independent valuation of Level 3 instruments. Reperforming ECL calculations and validating macro scenarios. Testing hedge documentation and effectiveness tests. Testing collateral valuation and enforceability. Checking consistency between IFRS 9 classification and IFRS 7 disclosures. Completeness testing is the most common and time-consuming step. Atypical mistakes and red flags. Maturity tables shown as carrying amounts. Weak or no ECL narrative on macro assumptions. Missing concentration disclosures. Stale or unreasoned sensitivity analyses. Inconsistent alignment between IFRS 9 and IFRS 7. No Level 3 roll forward or sensitivity. Missing hedge effectiveness evidence. Interview cheat lines. Sadie slowly. IFRS 7 explains the significance of financial instruments and the risks they create. 3 material risks: credit, liquidity, market. Liquidity disclosures require undiscounted cash flows by time band. Show credit concentration and ECL staging with macro assumptions. Ensure alignment with IFRS 9 and IFRS 13. Any mismatch is a red flag. End of. Final wrap. Short. South Africa IFRS 7 requires clear, complete disclosure of financial instrument significance and associated risk. JSE issuers must show maturity analyses, sensitivity analyses, concentration details, fair value hierarchies, and ECL movements. Auditors test completeness aggressively, from ECL to derivative populations, and regulators expect transparent narrative linking risk management to quantitative disclosure. If you found this useful, subscribe to CandiMentor. We build interview-ready, regulator-friendly content to help you win audits, roles, and investor trust.